Let us continue with the marginal costing. We seen the meaning of marginal cost and the example for marginal cost and what is the marginal costing. Now let us see characteristics of marginal costing. So under this technique, the costs are divided into product cost, that is based on the number of units produced, period cost. This period cost is all about the fixed cost. So this fixed cost is ignored. That fixed cost is ignored in the marginal costing. So first point is all elements of cost are classified into fixed and variable components. Like we write sales revenue, then we deduct variable cost, we get contribution. From the contribution, if you deduct fixed cost, you will get profit. Bracket indicates minus figure. See, this variable cost is changes according to the quantity, but this is fixed. So whatever the cost, your total cost is divided into one is variable cost, fixed cost under marginal costing. Number 2, the marginal, or you can say variable cost, in our example we see indirect material, direct labor, such kind, or a variable factory overhead are treated as product cost. Or a cost of product. If you deduct this one, you will arrive at contribution. Third one, under this costing, that is a marginal costing, value of finished goods and the work in progress is also comprised only of marginal cost, even in calculation of FG and WIP. In the calculation of under marginal costing, the value of finished goods, work in progress is also comprised only of marginal cost. So that means fixed cost is not considered. Valuation of closing stock of finished goods and closing work in progress. But the point is, one note, while valuing the FG, variable selling and distributions are excluded. Selling excluded for valuing these stocks or inventories. Point number 4. Fixed costs are treated as period cost, as I explained previously. And where it is charged to profit and loss account. When I say charge to P&L account, it is expense to P&L account, not for the particular product. If it is absorption costing, it is charged to particular product, that we will see while taking absorption costing. Fifth point, prices are determined with reference to marginal cost and contribution margin. In my first example, for 10,000 they got a unit 3,50,000 cost. This is in rupees, this is a number unit, so per unit is a 35. Then we did 10,000 one product, that come up to 20 rupees per product. 3,50,000 20 rupees. So when you sell this one, it should be more than 35, your MRP. But when you sell this one new product, you can sell at a cheaper price. No need to be 35, it can be 22, or it can be 28, it can be 30, it can be 35, or it can be more than 35. Even though your earlier product's cost unit is 35 per unit, here it is lesser because of marginal cost, because of main element of fixed cost. So prices are determined with reference to marginal cost and contribution margin. Last one, profitability of departments and products. Determined with contribution margin. How to calculate contribution margin? We'll see that is a contribution divided by sales. You will get contribution margin. Next one is the determination of cost and profit under marginal costing. Revenue or a sales, it has to be deducted by variable cost. You will arrive at contribution. Then if you deduct fixed cost, you will get profit. This is a rupees, this is a particulars. This is a simple format. You need to be understood. There is a one bigger format. This is a easy and simpler format. I will give that format also. This is not, it is an expand of above format only. You will write revenue, you will write here amount, that is amount that is inner column, amount outer column. Revenue or a sales you can write that should come in outer column. Then comes product cost. This is product cost with regard to variable cost. So first one comes direct material, that all comes in inner column. Direct labor or employee, next comes direct expenses. These are variable. Next comes variable manufacturing overhead. Is all in a column. We have to write product cost at outer column. Before that, you make a can write here product cost. About inventory, inventoriable cost, the total will be added here. If you deduct this one, you will get product contribution margin. That is how A minus B. This is a B. A, this one, outer column. Next comes variable administration overhead. Variable selling and distribution overhead. These are not in a factory, so it come in a separate. It is expansion of that previous variable cost. At the end you will get contribution margin. This, let's say C. Then we can calculate period cost, that is with regard to the fixed cost. Fixed manufacturing expenses. Fixed non-manufacturing expenses. Profit or loss also possible. Let's say this is a D, so we have contribution C minus D, you will get profit or loss. This is not so very important, but you should know this one, this format. This format is very important. Star mark. Revenue minus variable cost, will get contribution minus fixed cost, will get profit or loss. We'll have one example.